Hey, good afternoon, everyone. Welcome to Watch Your Six. I'm Jason Edwards. Glad to have you back. So, one thing we're hearing a lot about with clients, they ask us about passive versus active management. And really, what you're talking about is your rate of return. So, active and passive are very simplistically a different way to do investing. So, in one side, you've got a group that's trying to actively buy and sell positions in an effort to outperform the market. And you have some good investment firms and investment planning firms like ourselves that work actively to try to do that. Their goal and objective is simple: outperform the market. We want to make sure that they take into consideration your age, your time horizon, your liquidity, but all those factors go into their management style. And sometimes what you'll find is the cost may be a little bit higher, but if that cost results in a 10 or 15% growth rate greater than what you expected, it's usually worth it. So that's really where you see the active management. And we always tell people it's an individual decision. It's based on the person and the situation that individual is dealing with. Now, on the other side, you have what they call passive management. It sounds just like it's described. Passive, you're not really doing anything. And those are traditionally designed to really just mimic the market. So you'll find things like an S&P index fund or an ETF. And most of those, not all, but most of them are passive in nature. All they do is mimic what the portfolios already do. So those funds are buying the exact same things or owning the exact same positions of indexes that they mimic. So if they want to potentially grow as well as the S&P index does, that's what that fund does. Now, the downside with that is you're going to have a portfolio that is going to ride every wave. So if I buy an S&P index fund and I'm in the S&P and the S&P goes up 20 and drops 30, I'm going to ride both of those roller coasters. Now, the upside to that, traditionally with passive income funds, is the cost is lower. There's not a lot of active management, so therefore the fund family doesn't have to buy good investment portfolio managers. They can just mimic an index that exists. So there's a benefit there. So sometimes when you're a little bit older client, or you've got a dynamic where you're trying to maybe be a little more stable and you're not overly concerned about a long time horizon, you may go with a passive blend. We traditionally look at individual portfolios because no one is the same. And as you know yourself, you have individual needs and goals. So sometimes a blend of both could be a good alternative to mitigate risk or mitigate the volatility, but maximize the growth potential. And that's critical. Remember, when you're investing, the one person that can be a benefit to you or a negative to you is you. If you allow your emotion to override policy or allow your emotion to override logic, we've discussed in previous podcasts, that's a recipe for disaster. So you want to make sure that you're not doing that. And you don't want to get drawn into any one strategy or one scenario. So when you're online and you see, some fund family saying, hey, we got a great passive income fund, the costs are low. Remember, if something costs you nothing, more than likely the service is going to be not that great, or you're not going to have a lot of engaged service. So your portfolio is going to do the exact same thing. Same thing applies with active management. If people start to say, well, we're going to move things around a lot and we're going to adjust things a lot, well, that also can be negative. Because obviously you want an investment group that has some logic behind their objective and goal. And if they're turning over, which means they're buying and selling constantly every year, that means they're almost guessing, that they don't really have any kind of philosophy or method to build or confidential nature to build a portfolio effectively. So those are key components that you want to look at, and those are really critical. But again, going back to what we discussed, passive and active have its places. Passive is really good for individuals maybe a little bit younger or looking for greater growth or not overly concerned by short-term risk or volatility. While the passive group may be an individual group that doesn't want to spend a lot and maybe have a shorter window, and maybe they're older in age, so they're not necessarily worried about massive digit growth, but they're looking at consistent growth with a little bit less wiggle in their portfolios we described. There are some huge managers on both sides of the case. And you're seeing now more and more the ETF and passive market is actually migrating and introducing active portfolios, because at the end of the day, you're paying an entity or company to do what? Manage your investments. And you want them to hopefully try to outperform the market both on the upside or downside. So those are critical things. Remember, the key components that go into it is not necessarily just the investment, but basic information: your age, your time horizon, your liquidity, your need for capital. And why do I say that? Well, again, if I'm investing portfolios, depending on their objective, that dictates how aggressive or non-aggressive I can be. So if I have a checking account and that is my emergency fund account or savings account, and that's designed to replace my loss of income for 6 or 7 months, I can't afford to have that invested in a market that could drop the same time I need it, right? But if I've got an investment in an account and I don't need that money for 4 to 5 years, well, history has shown us that even with the biggest market corrections we've experienced, they never last more than a couple of years. So you could withstand that kind of dip because ultimately the portfolio hopefully would start to rebound and you wouldn't necessarily have to use those funds when they're undervalued or underwater. So those are some really good things that you want to remember, and hopefully that gave you some insight on that. Another area that we've gotten a lot of emails about is diversification. And diversification is used a lot. It's like a buzzword. People talk about it, but they never really dive down to what it means. And it's not just simply buying different things. That's the misconception. So people will say, well, I've got a portfolio with mutual funds and I bought 5 or 6 different mutual funds. I bought a large cap mutual fund. I bought a small cap mutual fund. I bought a mid cap mutual fund. I bought an international fund. I'm diversified. Well, maybe you're not. So for example, when you look in those portfolios, if you ever drill down in those funds, sometimes it actually owns the same companies. So there's a level of redundancy. That's the first part. Secondly, if it's managed by the same investment firm or the same custodian, you may have a manager managing both funds. So while the fund title or objectives may be listed as separate, you've got a person who has a very similar philosophy actually managing both funds. So when you talk about diversification, and we do that with our clients, you want to do a deep dive. You want to sit down and really have some individual or professional look at your funds on a granular level. Look at their top 10 holdings. Look at their money manager. Look at their history. Look at their deviation. Look at their turnover ratio. What does that mean? Well, how many times do they buy and sell or change their investment holdings? Those are all key components to determine, are you really truly diversified? And it would probably be a good idea maybe not to have all of your funds with one custodian. So let's say you're with one fund manager, split up that fund so that they're with multiple money managers in different entities. Therefore, you're creating another layer of diversification and another protection against any kind of insolvency issues. So diversification is one of our biggest components that we try to utilize when we meet with our clients. And unfortunately, until we sit with them and do a deep dive of their portfolio, which everyone should do, they're blown away by how not diversified they are, how much redundancy or repetitive investment strategies they are. So there are tools that we use at our firm that'll help us look at any portfolio and really identify that. And then it's a simple tweaking or adjustment that can really help you. So that's a critical component. And that's something that people overlook. But remember, diversification isn't simply just buying a fund and having different names on it. That's all. So we've got some really good questions that came in from emails that came from some audiences. So we're going to take some questions here, and then we're going to hopefully give the audiences some answer.
Hey, what's up, Jason? I really like the last couple of podcasts. I watched one about your dollar cost averaging that really helped me think about when to enter the market. My fiscal year ended in February, and I got a nice bonus from my boss. I see that these Q3 quarterly reviews are coming in, or Q2 quarterly reviews are coming in soon, and I'm wondering if I should be looking at some of those quarterly reviews before I jump into any stocks, or if I should just be buying now and dollar cost averaging just stocks that I think are going to do well, or should I wait for the quarterly earnings before I purchase some of those stocks?
So the question we have from our audience is basically trying to time the market or stick with what we call the DCA model. And if you remember in our previous podcast, we used some statistical numbers to illustrate why timing the market is so dangerous. Remember, from 1994 to 2004, the S&P yield was about 7.5%, 8%. During that time period, if you were out of the market 10 of the best days over a 10 to 20 year period, your rate of return dropped to 3. So that means that person mistimed what was the best time to get in. That was just 10 days. During a very long period of time, he missed it. So the problem with the strategy of trying to invest based on quarterly returns is you don't know when the bottom or the top is. That's the reality. The data could be positive, data could be negative. We don't know. But if you're sitting there almost like a gunslinger ready to pull the trigger and you're watching the market, you could be off by a couple of seconds or a couple of hours, and that's it. You've dropped the bottom or you've missed the top. So we always recommend find and create a very sound investment strategy first and foremost. Sit with your team. Make sure you've got an investment strategy that you're comfortable with, that's got some legs to it, some history. We don't want to invest in anything that's brand new. But then invest consistently. So if you've got quarterly earnings reports coming up, throw those to the side. That's great from a fundamental perspective, meaning your analyst team should be looking at that and say, hey, it's still a good investment. but you should be investing every month. So if you pick the first of the month, every month, first of the month, that money goes in. If you get a quarterly bonus, what's a really good idea is put that money into your account and then ask your team, your investment team, okay, I dumped $1,000 in, I dumped 2,000, I dumped 20,000, I dumped $1 million, whatever the number is. Now break that up over the period of times we normally invest in, right? So if I put $1 million in or $1,000 in, but I was investing 200 a month, then it's 200 a month. Let that money sit in the money market or cash side, and they will slowly start to peel it out and put it into the investment side. So you're still implementing the dollar cost averaging, but I do strongly recommend get that money out of your pocket. Remember what happens when cash sits in our pocket, what do? It burns a hole. So you want that money out of sight, out of mind, put it in your investment tactic, but then have that strategy deployed. Dollar cost average it over the next 4 to 5, 6 months. But at a 6-month window, you really want all of that bonus in the investment market. Good question. So we got any other questions?
What's up, Jason? I really like technology. I'm very emotionally invested in the technology. I think it's a great thing. In my portfolio, I have pretty aggressively invested into AI and technology companies. I would say around 15% of my portfolio is AI and technology, and I want to up that because of these awesome earnings I've seen from NVIDIA and Google AI to maybe 25 or 30% of my portfolio. Is that something that I should talk to my investment professionals about? Is that something that I could just do? How would you recommend me if I want to be more aggressive in at technology?
Yeah, so we have a really good question about what we call the asset allocation, how your portfolio is invested. And what will happen traditionally is when a particular part of your portfolio starts to sing and do really well, clients get excited. Remember in some of our previous podcasts, we talked about one of the biggest things that can impact us is greed. So we have a good portfolio, it's doing pretty well, we want a little bit more. And what happens is we start to throw caution to the wind or logic to the wind, and then we start to do on our own. And then what we really create is an environment what we call like a little, gerbil wheel. You're chasing returns. You're putting money here. Oh, that didn't good. Let me go over here. So what you're referring to is called rebalancing. So rebalancing your portfolio simply means is I'm going to tweak how the investments are set up. If I've got 20% in technology and 15% in US cap and 10% in bonds and 5% in Europe or whatever the balance is, do you tweak it yourself or what's the best way to look at that? So what I always recommend first and foremost, sit with your financial team. Let them look at the things you're missing. So that's why on our show, Watch Your Six, there are so many little pitfalls that people don't think about when they start to chase a return. So if you're trying to, for example, expand into technology, well, is it a good time to do that? Because remember, if that sector's doing well, it's probably a little bit expensive. So if it's a little bit expensive, some of those things you're buying are probably overpriced. So would that be an ideal place to put your money, or would it put areas that maybe are underpriced and that will eventually start to rise in value? So that's why you have an asset allocation. Your portfolio should be set up so that when one boat rises, another one sinks and vice versa. What you don't want to put is all your money in this rising boat and then it sinks and there's nothing here to offset it. So I would be leery of trying to chase a return. We have a history in the market of sectors that do really well. There is all kinds of periodical tables and things that can show you how different areas have done better over periods of time. And no one sector ever stays at its highest point forever. So if you're getting a little excited and you're saying, wow, this area is doing really good and I see some really good forecasting, sit with someone part of your team. Get their insights so they're not emotionally involved. Let them look at it honestly, and then that way they can take some of the emotion out of it and see if it's a good move. Maybe your portfolio is already too heavy, or maybe because of your age, you can withstand some of that volatility. But that would be the better way to go versus just making that decision, pouring money into one entity, and next thing you know, that entity explodes. I mean, in 1999, we had the market, which was huge in technology. It was an emerging market, as we know, and then that market imploded, and millions of dollars were lost, and some of those positions have never actually recovered. So you have to be careful chasing a return. Good questions. So we got one more question.
Jason, I'm doing really well with my portfolio. I've been doing really well with my job, and I'm looking to invest more into real estate here, but I'm scared because of all the news I'm seeing about the Fed either raising rates or the inflation causing run out of control house prices. And so I'm wondering, do I talk to a financial advisor before I make my purchase on my third home, I really want to have another rental investment property to help me diversify, not just in my stock portfolio. And I'm scared about what I'm seeing on TV. How do I manage that?
So we get a lot of conversations or questions about real estate growth, and we have a lot of individuals that like to buy into real estate because they like the passive income strategy. You may have heard on previous shows, though, I don't fall in love with the investment, I follow the rate of return. So while real estate sounds great, the thing you have to be careful is becoming illiquid. So if you're leveraging yourself to buy multiple houses, right? You're buying those multiple houses and you're buying this house and that house, but you can't necessarily pay it off. You're using a mortgage to pay for it, those kind of things. What you have to be cautious with is becoming illiquid. So what does that mean is that you have multiple homes, you've got notes on multiple homes, but you've got to cover those notes. So what does that expose you to? A default risk. You've got a scenario where your individuals renting the properties, let's say they decide, you know what, I lost my job, I'm moving out. Well, you could be stuck in theory with 3 mortgages. So when you start thinking about expansion of a real estate environment, you want to make sure that A, you have the liquidity to protect you or hedge you against the propensity to have to buy those homes yourself or pay for those homes yourself. Now, interest rate concern, which is what our caller was talking about, is another variable. So you say, well, I don't know if rates are going to go up or rates are going to go down, but here's what I'll tell you. Never rush into an investment decision when you're having to force yourself to do something. Remember, rates have gone up, rates have gone down. People seem to forget, back in the 70s, you had interest rates at 12 to 18%. Then you're talking about early 2000s, they were down to 4 or 5. Now they're 6 or 7. So nothing stays forever. So there'll always be an environment that's going to be necessarily a buyer's market or will be a seller's market. But I really caution people behind expanding their real estate portfolio if they don't have liquidity and they're diversified. You have to think about real estate, even if you own a house, as an investment, part of your allocation. I wouldn't tell you to put 65% in US large cap. That would make no sense regardless of your age. So likewise, I wouldn't say put 85% in real estate, buy 5 houses in your location, local neighborhood, and that's where all your investments are. Why? Well, think about the risk. First of all, there's the default risk we alluded to. How about, storms? There's critical risk. There's all kinds of dynamics. If you're in the same area and that entire area gets hit by storms at one time, what's happened to your portfolio? And then third and foremost is your inability to pay those expenses. Let's say you lose your job and you've got 5 properties. So then what happens? Those properties go REI or they get foreclosed and now you've lost all of your assets. So the market cycle as it relates to interest rates shouldn't be necessarily the biggest determining factor. It can be a component. But really, I think the bigger component is looking at, are you leveraging yourself to get these properties? Are you taking money from one place that's making 15 or 20% and it's fully accessible to put it in another property that could take 5 to 10 years based on the rent you're charging to get that money just to be rebounded or to again, replenish that coffer, so to speak, and to recapture that money, which is just your initial investment. So those are some of the key components I'd be concerned with, and that's something you have to, make sure you look at. Anyway, thank you so much for tuning in to Watch Your Six. We look forward to seeing you next week, and we look forward to answering more of your questions on your podcast. We also got some really cool, exciting interviews coming up in the next couple of weeks, so hope you tune in for those. Have a great day.